is that they can repay the dollars in money that's accepted by the government because the Federal Reserve will give the banks enough money to pay the government and remain solvent. So it's as if the whole economy today is being run to keep the banks solvent, not to produce more goods and services, not to raise living standards, but all for the aim of increasing bank profits.
Exactly. Now, the Fed is not really the government. Isn't it private bankers?
No. Officially, the Fed stock is owned by private bankers, but private bankers need the government in order to provide official public credit. For instance, when the Fed did $2 trillion of cash for trash swaps last year, it let the banks give them junk mortgages that had nothing in back of them, and it asked the Treasury to print $2 trillion worth of Treasury bonds to give these banks as real security so the banks wouldn't be in negative equity and be bankrupt. The Fed needs the government in order to give it official money.
Well, now, who prints the money, the Fed or the government?
The government. But the government will turn it over to the Fed, and so the Treasury and the Federal Reserve work together. Basically, there's no need for an independent Federal Reserve at all. It basically could be part of the Treasury, and even Milton Friedman on the right wing of the political spectrum recommended that the Federal Reserve simply be a desk inside of the Treasury, as basically it was before 1914.
Well, exactly. That's what I thought.
The government technically will issue bonds that pay interest, but it doesn't. Essentially, the government lends the banks the money to relend it. So the government lends banks money at 0.25%, and the banks can turn around and buy government bonds, which now are only yielding about 1%, so that doesn't pay very much, but they can lend this money to other countries that pay much higher rates of interest. So that's basically what's happening now. But usually it's always been the government that lends banks the money to lend it at a markup, and the markup is how banks make their money.
I see. So say the government lends money at 0.25% interest to the Fed or to the banks?
No, it gives money freely to the Fed, and the Fed gives it to the banks at 0.25%.
I see, and then the banks raise the interest rate when they make loans to others.
Right.
I see. Ben Bernanke has been reappointed as chairman of the Federal Reserve. He is touted as the best choice to head the Fed because he's an expert on the causes of the Great Depression. What conclusions did Bernanke draw from his study of the Great Depression, and do you agree with his conclusions?
Well, no professor I know believes that he's an expert at all. He's what you call a useful idiot. He misinterprets the Depression in the way that neoclassical and monetarist economists normally reinterpret it. He has a banking eye view of the Depression. From his point of view, the problem with the Depression was the banks didn't have enough money to lend out. And of course the banks could have lent as much as they wanted to. There was nothing to lend to. But he said the only problem is banks didn't lend money to get the economy going because prices for real estate and bonds were so low. And he said if only prices for real estate would have been higher, if only all these people out of work would have had to pay 5 times as much for their housing as they did, if only wages would have been much lower than they actually were, and if only, well, a few million people would have just died quicker, and if people would have been paid cheaper, we would have got out of the Depression quicker. Now, that's garbage. That's crazy. And every professor I know thinks he is a disaster for the Fed, and that is what has led the labor unions and most Democrats to have utter contempt for President Obama. No Republican could have got by with appointing such a right-wing extremist as Mr. Bernanke to the Fed. It takes someone with a friendly face and a Democrat to pursue a right-wing policy that the Republicans could not have gotten away with. And that essentially is what Obama and Bernanke is doing. The Obama plan is to lower wages in the United States by years and to put the class war back in business. That's the people he is putting in office are to do that. And that is Bernanke's idea, that the way to solve the problem today, as in the 30s, is not to reduce the debts, not to roll the debts down to the ability to pay, but to inflate prices for real estate, to inflate stock and bond prices, to create a boom so that it'll be even harder for Americans to buy houses, even harder for them to buy a retirement income, because if you put your savings in a mutual fund these days or a pension fund, you're only getting about 1% on government debt, and that's pretty much the risk-free rate. And the result is that the pension savings and the retirement savings of Americans and also Europeans are basically going to be wiped out. The Obama plan is to get rid of Social Security, get rid of medical care, or downsize them so much that people are not going to be able to get the money that they'd expected to get in retirement. And this is to use the savings to pay the banks and essentially the wealthiest 10% of the population at the expense of the lower 95%. And it'll be done with a smile. He'll say, gee, I'm really sorry you're all getting poor. I'm sorry you can't afford insurance. I'm sorry the lifespans are shortening. But he's really not sorry at all.
I'm speaking with financial economist and historian Dr. Michael Hudson. Today's show, The New Junk Economics, From Democracy to Neoliberal Oligarchy. I'm Bonnie Faulkner. This is Guns and Butter. You have written that for Mr. Bernanke, more debt is not the problem, it is the solution. This is what makes his reappointment so dangerous.
That's correct. The idea is essentially to help the banks. That's what Mr. Bernanke thinks the aim of the Federal Reserve is. He's going directly against the Federal Reserve Charter, whose first line says it's supposed to support employment and living standards. Mr. Bernanke says we need to lower employment. We have to lower living standards. So he's going exactly the opposite of what the Fed's supposed to do. He said we have to help the banks get out of the fact that they've made all these bad loans by inflating the economy again so that the assets they have, all this real estate they have on their balance sheet, will get above water. He's actually trying to convince Americans in negative equity, where the mortgage is higher than the housing price, to pay their mortgages instead of walking away from the bad debts. I think that the solution should be that Americans should simply stop paying the mortgages in these houses, walk away, let the banks foreclose, and buy back the house or a similar house at half the price, and leave the banks with the bad loans on their balance sheet, just like a commercial operator would do. But Bernanke is trying to just get the banks lending money again to make so much mortgage money available that somehow the prices will go up and save the banks.
You talk about two economies, and that today the two economies are finance versus debtors.
That's basically it. People think of the economy as being industry, production, and consumption, and that's economy number one. But that's not the economy that the Federal Reserve and the government is aiming at. They aim at the economy of assets and debts. They aim at the financial, insurance, and real estate sector, the FIRE sector. And their objective is to increase the price of wealth of assets relative to the price of labor. And the first economy, the production and the wage sector and the industrial capital sector, are being depleted in order to provide more revenue for the FIRE sector.
You emphasize that it's a myth that money works, that humans work. Wealth grows in society because of the efforts of the rest of society.
That's right. People say money managers will advertise by saying, let your money work for you. And the idea is that somehow the money is magically increasing by compound interest. But money doesn't really do anything itself. Somebody has to. Money is really debt. And this money that people give is invested in IOUs or loans or some kind of financial financial claim on wealth, not on creating tangible wealth. So this money that people get from investing in mutual funds or pension funds has to take the form of profits or rent or capital gains, but it doesn't actually produce anything.
Now, you spoke a moment ago about Ben Bernanke's analysis of what caused the Great Depression. What would your analysis be